Hello, I'm Kimberly Romaine, Editor-in-Chief at Unquote magazine. I've got with me here today Ken Landsberg, Managing Director of ECI Partners, a UK mid-market buy-in and buy-out specialist. Thank you very much for joining us today, Ken.
Pleasure.
We're going to be talking today a little bit about the UK mid-market, an area that you know a great deal about. It was about this time last year, November 2008, that you were halfway through raising ECI 9, your latest vehicle. You launched in a tremendously difficult time, and yet despite the conditions managed to close it just 3 months later. That was immensely impressive then, and even now, 12 months later, is an extraordinary feat. Can you talk us through a bit about how you went about doing that?
Yes, certainly. I'm delighted you asked me. I mean, as you say, we launched in September last year. It's been a long 12 months. And a week later, Lehman's collapsed. So at that point in time, there was really a paralysis, if you recall, in decision-making throughout the financial services industry. And yet, 3 months later, we were delighted to be able to close that fund ahead of target and in a single closing. The process was eventful. It was interesting. We learned a lot more about our investors than we expected to learn.
And as you alluded to, it wasn't entirely without its hiccups. You had most of your existing investors re-up. I believe there were a couple that didn't. If you were to go about that process again today, had you launched now instead of 12 months ago, how do you think you would have fared? What do you think the market is like now?
Yeah, I mean, 12 months is a long time, and things have changed. We haven't got the paralysis in the industry that we had then. I think there's more clarity of decision making, but there's probably less funding than people expected to have. So some very good names have gone out to the market in recent months and been asked by their investors to come back later. They don't want to fund them now. On the other hand, there have been some successful fundraisings, as we know. So we'd like to feel that our investors would have supported us if we'd gone out now.
Just weeks after your fund close, you managed not only to sell Rakel Acoustics for a fantastic multiple, you also took private a company called Ascribe. So you had a very busy sort of month and a half period right around the holidays last year. Since then, however, we've covered very little of ECI's activity and Unquote. I understand you've probably done some bolt-on acquisitions, about half a dozen in the meantime, but you've been very quiet in the way of new deals. Can you talk us through how you've been faring in 2009?
Yes, certainly. You're right. December, January, the turn of the year was a great period for us.
Even as others found it immensely difficult.
Indeed, it was quite surrealistic at the time, I have to say, to live through it. Yeah, we have been low profile. We've been helping our portfolio make bolt-on acquisitions for a variety of reasons. Some of them buying technology businesses, products, access to international markets, but really quite small businesses. And because this market has been slower, and there's no question about it. I mean, in a downturn, there are less transactions and they take longer. I think the main reason for that is that the vendors of businesses suddenly have a different frame of reference to contend with, and they have to rethink again, and that takes a bit of time and slows down activity, makes transactions that are in process much more protracted. But it is a great time to invest, and we're very keen to invest.
The first sort of 3 quarters of this year have been very, very slow, the first quarter in particular. It's only in the last couple of weeks that Unquote has really noticed an uptick in activity. During the slow time, when we did see deals being done, quite a few private equity houses in your space had been providing much larger equity tickets. I think we were noticing an average of about 50% equity, which is vastly up on if you looked back 2 years ago. Some equity houses were even completely underwriting the deal, either with a view towards bridging it later with debt or just holding on to that debt for quite some time. Is debt underwriting and/or all equity deals something ECI considers?
We consider it. We have the ability to do it from our main fund. Absolutely, no question, to underwrite the whole deal, to create a bought deal. But there's a question as to why it's necessary. I think there was a short period during the year when, really early in the year and perhaps towards the end of last year, when the banks were under pressure. They didn't really quite know what their authorities were in terms of new lending. And there was a bit of a hiatus, but it didn't last for very long, and it didn't apply to all banks. So, for example, Scribe was 50% funded by bank debt from Clydesdale Bank, who are a new up-and-coming player in the industry now. And transactions we're working on now, we're absolutely getting banking competition for them. It is important to be on their preferred sponsored lists so that they will lend to you. But there's no problem in the banking at the moment. This is bread and butter business for them. They have budgets to lend. In some cases, they're not meeting their budgets.
So you said just a moment ago that this is a fantastic time to invest. Presumably you've got a pipeline of deals. Are any of the companies in that pipeline not having some banking competition? Are there any deals that you're looking at that don't have at least two banks looking at it?
No, they're all banked and fully banked on a reasonable multiple debt-to-equity ratio, probably 1-to-1 debt-to-equity. And while we've been ready to underwrite debt, there's really been no occasion for it. And I think perhaps one of the questions one has to ask is if the bank, especially now, once we're through this hiatus, if a bank isn't prepared to lend debt, then maybe it's a very high-risk deal that we wouldn't be wanting to do.
Have you walked away from any on that basis?
No.
Speaking of other people doing deals, we've seen a number of announcements lately that there may be some IPOs on the horizon. If you speak to corporate, or quite a few IPOs in fact, if you speak to corporate financiers, a lot are talking about an increase in quality deals coming on their books, good IMs they're putting out that they feel very confident will find attractive buyers. Is this the true beginning of a recovery and an upturn? Or is this the top of the middle of a W curve? What are your thoughts on this?
I think it's true to say that there is increased activity, and you've got a lot of statistics on that. We monitor some lead indicators on that. So not only are new transactions occurring, the increasing number of new transactions, but there are more companies coming onto the market. There are more mandates being won by advisors and more mandates being bid for by advisors, and all these lead indicators are suggesting that there will be a slow and gradual increase in the number of transactions happening over the course of the coming months and quarters. It won't be a return to the 2006-2007 levels of activity, but it will be a slow and gradual increase. I think an interesting, obviously one looks to history to get some insight as to what may happen, and there's an interesting contrast with the 1980 and 1990 downturn that we saw at the time, which was then there were high interest rates, very high interest rates. And the problem with high interest rate is if a company can't pay it, then the bank's debt is not performing, it's impaired, and they may need to put the company into receivership in order to recover their loan. That may be the action they feel they need to take. And so there was a lot of carnage around in the 80s and 90s. This time it's very different. We've got super low interest rates. The bank's loans are performing. They may not be able to pay back the capital, and capital repayments can be pushed out, but it's still a performing loan, and therefore the company doesn't need to be put into receivership. So there's a lot less of that going on. It's temporary, however, because interest rates will need to rise. There's no question about that, and the latest expectation is sometime during the course of next year, interest rates will start to rise. But unless that's done in a particularly harsh way, I think we will see it as part of a slow, progressive normalisation of the economy. At that time, however, the banks will want to offload some of their highly leveraged customers. So we've had the benefit of a recovery in the economy, of time being bought for the economy to recover, for asset prices to rise. I think we'll see the fruits of that now over the next 12 months as more transactions start to happen.
Thank you very much, Ken, for taking the time to be with us. This has been Ken Landsberg, Managing Director of ECI Partners, and I'm Kimberly Romaine, Editor-in-Chief at Unquote. Thank you very much.